All right, welcome class. In our course Accounting for Decision Making, we're really going to start moving beyond just the basics of debits and credits. Today, we are tackling a concept that, honestly, is right at the heart of strategic financial management: asset impairment. Now, this is where accounting stops being just a history lesson, recording what happened in the past, and it starts actually shaping the future. Understanding this isn't just about passing your next exam. It's about equipping you to make some really critical, high-stakes decisions when you're in the boardroom. It's all about making sure that the financial story a company tells isn't just accurate, but that it's a reliable guide for the path forward.
So to really get our heads around this, let's put ourselves in the shoes of a manager for a second. Imagine you're the chief operating officer of a big manufacturing firm. Your company's absolute crown jewel is this custom-built, multi-million-dollar robotic assembly line. This thing is listed as a major asset on your balance sheet. It's a symbol of your company's strength. But then, one morning, you're reading a trade journal, and you see an article about a breakthrough in AI-driven robotics that makes your flagship asset look like, well, a relic. All of a sudden, that cornerstone of your balance sheet feels a lot more like a millstone around your neck. So what do you do? As the manager, what's your next move? How do you responsibly report this to your stakeholders? See, this isn't just some textbook problem. This is the exact kind of challenge that defines entire careers.
Okay, let's flesh that out a bit more. Let's say your firm invested, $10 million in this specialized machine about 5 years ago. It has been the absolute workhorse of your factory floor. Then, a competitor unveils a totally new 3D printing technology. And this thing doesn't just make the same product. It does it with less waste, it allows for on-the-fly design changes, and it operates at a fraction of the energy cost. Your machine, which was once your big competitive advantage, is now a huge liability. The products it makes are suddenly becoming way too expensive to compete in the market. This isn't just a technical problem, you see. It's a profound financial crisis brewing right there on your factory floor.
And this is exactly where the principle of faithful representation in accounting becomes so critical. Your balance sheet, at this point, is frankly misleading. It might say you have an asset worth, say, $5 million, but its real economic value, what it can actually generate for you in the future, has absolutely plummeted. Now, think about the consequences of that. If you go to a bank to get a loan and you show them that balance sheet, you are fundamentally misrepresenting your collateral. If you're trying to budget for next year's production, all your cost per unit calculations are skewed because your depreciation expense is based on a wildly inflated value. Every single strategic conversation you have is now built on a foundation of falsehood. This is precisely the problem that the principle of asset impairment is designed to solve.
So how do we fix this? How do we bridge this massive gap between what our books say and what reality is? Well, accounting standards, both under GAAP here in the US and under IFRS internationally, provide a very structured mechanism for this. We can't just arbitrarily decide to write down an asset because we read a scary news article. No, there's a formal process, and it's called the impairment test. I want you to think of this as a diagnostic tool that accountants and managers use together to make sure the balance sheet remains a relevant and faithful representation of what the company's assets are truly worth.
The very first step in our test is to figure out the asset's carrying value. You'll also hear this called its book value. Now, this figure is purely historical. Let's break it down. We take the original acquisition cost, so everything we paid for the machine, including delivery, installation, all that. Then, from that, we subtract accumulated depreciation. And remember, depreciation is just the systematic allocation of an asset's cost over its useful life. So the carrying value is essentially the chunk of the original cost that has not yet been expensed through depreciation. It's what our accounting records, based entirely on past transactions and old estimates, claim the asset is worth right now.
Okay, now we need something to compare that historical carrying value to. And that something is a forward-looking measure called the recoverable amount. This is where we get into economic reality. The recoverable amount is defined as the higher of two potential values. The first one is its fair value less cost to sell, which is pretty simple. It's just, what could we get if we sold it on the open market today after we pay any commissions or legal fees? The second one, and this is often the more complex calculation, is its value in use. This requires us to forecast all the future net cash inflows we expect to generate from continuing to use that asset in our operations. But, and this is key, we can't just add up those future dollars. We have to discount them back to their present value, because a dollar we earn 5 years from now is worth less than a dollar today. So we figure out both of those numbers, the selling price and the value in use, and we take whichever one is greater. That becomes our recoverable amount.
So the impairment test itself really just boils down to a simple logical comparison. We take the carrying value, that's the historical number from our books, and we place it right next to the recoverable amount. That's the forward-looking number from our economic analysis. The rule is completely unambiguous.
If the carrying value is greater than the recoverable amount, the asset is impaired. It's that simple. And what this means, in plain English, is that our books are overstating the asset's value. We have an accounting problem that absolutely requires correction to prevent our financial statements from being misleading.
Now, a common misconception that I see from students is that companies are just constantly performing these super detailed impairment tests on every single asset they own. Well, that would be prohibitively expensive and incredibly time-consuming. So instead, the accounting standards require companies to be on the lookout for what are called impairment indicators, or triggers. At the end of each reporting period, management has to assess whether any of these triggers exist. And this isn't just an accountant's job, by the way. Your operational managers, the people on the front lines, are often the very first to see these warning signs.
These triggers are broadly categorized as either external or internal. External factors, as the name suggests, come from outside the business. The new technology introduced by a competitor in our example, that's a classic external trigger. Other examples could be a new government regulation that restricts how you can use your asset, or maybe a sustained downturn in your market. Internal factors, on the other hand, arise from within the company. An obvious one is significant physical damage to an asset. A more strategic internal trigger could be a management decision to restructure operations. For example, if you decide to shut down an entire product line, all the machinery that was dedicated solely to that line might now be impaired because its value in use has just dropped to zero.
So, our test has confirmed it. The carrying value is greater than the recoverable amount. The asset is officially impaired. So what happens next? Well, we can't just make a note in a file and call it a day. Accounting principles demand action. We have to formally record this economic loss in the financial statements. This is the crucial step where all that analysis translates into a tangible change in the company's reported financial position and its performance.
The accounting entry for this involves two steps that affect two different financial statements. First, on the income statement, we recognize an impairment loss. This loss is calculated as the difference between the carrying value and the recoverable amount. It gets treated as an expense for the period, which means it flows directly to the bottom line, reducing the company's net income. Second, on the balance sheet, we reduce the asset's value. We credit the asset account to write it down from its inflated carrying value to its new, more realistic recoverable amount. And just like that, the balance sheet is now a much more accurate reflection of the company's resources.
Now, I really want to address a very common psychological trap that students and even seasoned managers fall into. Seeing a huge impairment loss on the income statement can feel like you're admitting to a past mistake, that the company overpaid for an asset or that it failed to adapt. But you have to resist this view. Recognizing an impairment is not a failure. It is an act of integrity. The failure lies in ignoring the impairment. Knowingly leaving an overvalued asset on the books is misleading your investors, your lenders, everyone. A responsible manager faces reality and provides stakeholders with a true and fair view of the company's financial health. It's about transparency, not about blame.
Okay, this brings us to what I think is the most important part of our discussion for you as future business leaders. Why does any of this matter for making smart decisions? This is where we see that asset impairment isn't just some dusty technical accounting rule. When you understand it correctly, it becomes a powerful source of business intelligence that can and should drive strategy.
Let's think about the real-world impact across a few key areas. First, investor trust. A company that promptly recognizes impairment is sending a signal to the market that its management team is realistic and transparent. Second, strategic planning. The impairment analysis provides hard data for your capital budgeting decisions. If you now know your old machine's recoverable amount is only $500,000, well, that makes the decision to invest $3 million in that new technology much, much clearer. Third, access to capital. Lenders base their decisions on the quality of your balance sheet. An accurate, unimpaired balance sheet gives them confidence to lend you money. And finally, it actually leads to more accurate profit reporting in the future. By writing the asset down, your future depreciation expense will be lower, reflecting the asset's reduced service potential, and that gives a much truer picture of your future profitability.
So I really want you to fundamentally shift your perspective on this. An impairment loss is not a punishment for past decisions. It is a powerful signal from the market. Think of it like a flashing light on your car's dashboard, telling you that the operating environment has fundamentally changed. It forces a strategic conversation that, honestly, might otherwise be delayed or ignored. It's the catalyst that moves a company from saying, we should probably look into that new technology, to we must create a plan to address this new technology right now. The most resilient and successful companies are not the ones that avoid impairment. They're the ones that listen to its signal and adapt.
So I'm going to leave you with this question to carry with you into your careers. When you read in the Wall Street Journal that a major company has taken a $1 billion impairment charge, your first instinct might be to see it as a sign of failure. But I challenge you to look deeper. Ask yourself, is this the sound of a company finally admitting to a problem it has ignored for far too long, or is it the sound of a courageous management team that's clearing the decks, facing reality head-on, and preparing to invest in the future? The ability to distinguish between those two scenarios is what separates a novice from a truly insightful financial analyst. And developing that kind of critical thinking is exactly what we're aiming to do in this course.